Hello and welcome to the show. My name is Matt Kalinsky, and today we have the Staffing Industry Discussion video podcast with our guest, David Schek, who has 31 years of experience in workers' compensation, and he is very strong in terms of the staffing industry. So we are looking forward to having some great conversations with David Schek, who ultimately is going to help you decide the best workers' comp solution for your business. So without further ado, let's bring him on the show. And here we go. Hey, everybody.
Hey,
David,
Matt. How are you?
Good. How are you today?
Thank you for the invite. I've really been looking forward to chatting with you and your audience about staffing and workers' comp. And what seems sort of, after 31 years, what seems sort of second nature sometimes to me, sometimes, is sort of eye-opening for other folks. But even having said that, one of the reasons I love what I do is because I really do learn new things as I talk to new prospects and clients every day, because their business is always changing and we're trying to meet their needs. Absolutely. So anyway, I wanted to thank you, Matt, for the invite, and I look forward to having a nice discussion with you today.
Absolutely. David, I've known you now. Actually, when I first started talking to you 14 years ago, when I first started my business, and you've been on a lot of different components within the staffing industry. And I've always looked to you as somebody that can give me some good advice, keep me in the know. And I think all of our listeners today are going to take home a bunch of nuggets of information from you regarding evaluating their own workers' comp options, why workers' comp is so vital especially for staffing companies in general. And what are the options? A lot of changes occurred not only in the country, but specifically in workers' comp over the past 1 to 2 years. And so we're looking forward to having kind of a discussion on the state of the union from David Schek's point of views.
Okay.
So if you don't mind, can you give the audience an update about you and how you got into staffing and how did you get into workers' comp?
Well, that's a great question. I appreciate your ask. I started really in the staffing industry in 1989, and I started with my brother, who's a chef, and we started a hospitality culinary staffing business. Nice. And we started in Washington, D.C. And as most people know, D.C. is really made up of 3 states: the District of Columbia, Virginia, and Maryland. So if you want to serve all 3 markets, all of a sudden you have to be an expert at 3 different types of workers' comp. And the funny thing is about workers' comp is it's very state driven. There's very little federal, there's federal regulation, but the specific regulation is state driven. So we had to become experts in 3 states from day one. So we grew that hospitality company into a 65 office, $30 million staffing business, and we were in about 35 different states. Wow. So I started the hospitality staffing business with my brother, the chef, to help people. And I really got a great feeling, and I still do, and that's really the continuity between running a staffing company and providing work comp solutions to our 150 staffing clients now, is that I always like to interrupt
you here. Just to give some context to hospitality. Today's hospitality has the smallest margins and the hardest to fill orders in terms of compliance. What was it like when you were in that business in hospitality, growing into 35 states? What were some of the challenges you faced back then?
Well, that's a great question. What's funny is the first year of business, we thought, and we did marketing surveys that indicated that we should go after restaurants because they were the ones who really needed back of the house line cooks and wait staff. Yep. So we did that. That was the good news. We did about $400,000 of business the first year, which for a new business was not bad. That was the good news. The bad news was they didn't pay. So we spent half our time staffing the restaurants and the other half of the time going down and trying to collect our money.
Well, if you were in Chicago, you would just go and break some knees and people tend to pay, but I'm sure it's a little bit difficult being a professional staffing agency.
Right. And I didn't want my knees broken, conversely. So I still wanted to be able to walk around. And that was after only a year. So I didn't know I was going to be in this for 31 years at that point. So anyway, so we were really sort of discouraged, quite frankly, after 12 months and having a lot of money either not collected, or if we did collect it, it wasn't easily collected. So out of the blue, we got a call from a Marriott manager, and that Marriott manager was a cafeteria manager for a school, a private school, and Marriott ran that private school's cafeteria.
Okay.
And my brother, being a fine dining chef and having gone to the Culinary Institute of America, was not really tuned into that whole separate food service niche, which is called contract feeding.
Yep.
So contract feeding turns out to be about a $15 billion a year food service niche. So it's quite a large niche. And at the time, it was managed by 15 various contract feeding companies, Marriott probably being the largest. Marriott now was purchased by a French company called Sodexo. And Aramark is also another large company, and Compass, which used to be Canteen.
And these are like, the ones that service schools and the ones that's the cafeteria type pictures, right? Yeah.
Exactly. So contract feeding, and you just touched on most of the areas, is not only arena and stadium dining, but hospital, healthcare, which of course is booming, office, which is less than booming these days, and education, which actually is booming as well, and colleges as universities. So it's a huge niche and really managed by these large national and really international food service companies. So it didn't take long for us to figure out there must be other Marriott after we got that first call. There must be other Marriott managers. And of course, we were so disheartened from people not paying us. We knew the Marriott was going to pay. So we went down.
Was this still in the DC area? Or what
DC area. Okay. This is all DC area. So we went down and we spoke to the Marriott manager. One thing led to another. And we serviced them. And Marriott probably had about 50 or 60 units just in the Washington area.
Wow.
And each unit needed, various culinary help.
Wow.
So we started there, and then we realized that we could leverage our Marriott relationships and leverage that expertise with other contract feeding companies like Aramark and Canteen, etc. And we really just developed our footprint as a replication of their footprint in the various markets. So we went from, that's how we were able to go from the Washington area over to California and, most places in between by having those clients.
And so you were able to make a pivot at that point where you were able to start it in the restaurants. You found something wrong with the business in terms of the paying of the customers, but you were able to service them well. You were able to pivot within the first year and kind of go after this niche. And even though it's still hospitality, you found the niche within hospitality. And I think that's super important for a lot of staffing companies who are listening today. Having a niche is always important. Whether you're in the hospitality, find the niche within hospitality, or if you're in healthcare, find the niche within healthcare. But it's super important to grow your business through niche, which it sounds like you're in a great example from the 90s of how you grew that 30 years ago.
It's that, Matt, and also about 150 staffing clients we have, probably 50% came to us as newbies. And newbies are staffing company, usually salespeople who want to start their own staffing business. And those are the folks who I really love helping. Because while they have a great sense of how to build top line sales, they're not always as cognizant that it's the bottom line and the cash flows that really make or break a business. So a perfect example is our top line, our first year was 400,000. And when we said that number to people, people thought, boy, you guys are doing great. You guys know what you're doing. You must be making so much money. Little did they know that we weren't getting paid. So
I've been there and I've done that.
Because part of our relationship with all our clients, but especially the newbies, is helping them become successful in staffing as we help them with their workers' comp solutions, is talking about the nature of their business
right.
and the profitability of their business.
Right.
So it all goes hand in hand, as you know, Matt.
Yeah.
You know, all parts of the business have to sync.
I love working with entrepreneurs. I'm an entrepreneur at heart. Been one since I was 16 years old, you know, going on 20 years of just entrepreneurship. And so I definitely understand having those conversations with people, and they're like, I'm going to grow revenue and double it. And it's like, okay, but what is your net profit? What are you taking home? How are you paying the bills? And so, and that is one of the topics I like talking about is cash flow. But what are some of the challenges or risks like that you're seeing for startup staffing firms? Like, what are those risks? Have you been able to kind of classify those risks for new startups?
Well, the big thing is, and you mentioned it just a moment ago, are margins. Yeah. Because, and how have margins changed from when we got into the business in the 90s to what people usually think of a low margin business, which is food service or hospitality.
Yeah.
And unfortunately for the current group of hospitality staffing companies, margins are much smaller than when we started in the 90s. And we
ended up selling in the 90s.
Usually 70 to 80%.
Wow. I know that some like construction positions were even 90 or 100%. Now we're seeing 26 to 30%. So it's definitely different. For sure.
It is. And how that really impacts my work, our work today, is that workers' comp, because it is a cost that can vary not only state by state or business by business, is that staffing companies, I think, are much more attuned to what that work comp will cost them.
Yeah.
So there's, of course, with work comp, not to get too much into the weeds, but you have the rate that you're going to pay. But then in most work comp programs, you have a deductible.
Yep.
And that deductible, like a car deductible or any type of house insurance, rental deductible, that can add to your ultimate cost of the work comp program.
Yep.
So that should usually, and newbies don't always appreciate that when they go and they sell a client, they're popping the champagne. But if that new client ends up having a lot of accidents and they get dinged for that deductible, that work comp rate, which may have been $2 per 100 or 2%, all of a sudden all costs it becomes 5%.
Right. So that's their mod increases. Their mod rate increases across all positions, not just that one position.
Over time. Yes. Over time. Usually, they're for a newbie, it usually takes 2 to 3 years for them to get modded. But yes, it will affect all their clients. And of course, their margins get squeezed. And then when they go shopping again for work comp, the next work comp provider will look at their history and wonder how they're really managing their risks, which is the point you were just making.
Yeah. In the 90s, was it common to have so many companies was there larger policies for all 50 states, or was it common like it is today where there's groups of states that have policies, and then there's PEOs, and then there's EORs, and there's lots of different options? What were the options back in the 90s, and how has that changed over the past 20 years?
I think there have been multiple options throughout the years. I think there are more programs now available. In our particular case, we work with a PEO for most of the states. We also use state funds for some of the states. And then we also use a private carrier for some of the states. We generated about 25,000 W-2s a year.
25.
Right. So we used a large PEO. It happened to be about $1 billion PEO. And curiously enough, after we sold the business and I became a work comp consultant, started this company. Started this company. Thank you, Matt. It turns out this PEO that I had become a client and I loved, they were great, decided they didn't want to be in the staffing market anymore. And I didn't take it personally. They just didn't want to engage in that type of risk anymore. They wanted to do other types of companies. And staffing tends to be more of a high risk, from an insurer's standpoint, more of a high risk type of business. So there are still probably, I would say, 5 to 7 or 8 PEOs that make a market in staffing. That's one option. There are also options called employer of records, or EORs. And the difference between an EOR and a PEO is the PEO is a co-employer relationship where the liability is shared between the PEO and the staffing company. And with the employer of record, statutorily, the employees are 100% the EORs.
Right.
And why that matters is some staffing companies, and a good example is a salesperson gets into staffing because they want to build relationships with their clients. Right. They want nothing to do with the legally or statutorily speaking. They want nothing to do with the workers.
Yep.
So an EOR is a very good fit for them. On the other hand, with a PEO, you can often get a slightly lower or somewhat lower rate on the work comp as well as on the SUTA, state unemployment tax rate. Mm-hmm. So the PEO, while the liability may be shared with the staffing company, it can be a little less expensive than an EOR.
Right.
Another type of program, though, I'm sorry, Matt.
It's based on volume, though, right? So a lot of these insurance companies do give some discounts when it's associated with volume. What's your experience in terms of the volume needed to get any significant discount in an annualized payroll, just to kind of give our listeners some kind of guidelines in terms of what they should be expecting and how they would classify themselves based on your experience? So where do the discounts start coming in with a PEO or EOR in that case, in your experience?
It's a great question and a very logical question. The thing is that it really depends on ratios between the amount of premium the staffing company is generating and the amount of losses that they have incurred over time. And if the ratio does not look attractive to the carrier, and the carriers are all supporting the PEO and the EORs, because that's what they are. PEOs and EORs are really administrative partners with the carriers, supporting them from an insurance standpoint. Then they're either going to reject your application, or just, even if you're doing a lot of volume, they may feel that they'll accept you, but the risk is significant and your rates won't be commensurate necessarily with the high volume you're doing.
Right.
So there's a number of the bottom line is there's a number of factors. It really is not as clear cut as just looking at a matrix necessarily and trying to assign a certain volume with a certain rate. The other, another factor that gets integrated into the formula is what size deductible the staffing company. We're working with a client now who has, and this is unusual, they're able to, they have the financial resources. They're backed by a private equity company, and they have the financial resources to have $100,000 deductible.
Wow.
So they're responsible for the first $100,000.
Sure.
Well, so their rates are going to be lower than someone who has a typical deductible with a PEO, maybe $2,000. Mm-hmm. So, that goes into that. But at the same time, this client that we're working with is a relatively new client. So because they don't have a strong history, despite having $100,000 as a deductible that they're able to put into the kitty, put skin in the game, their rates are not going to be as low as if they had been in the business for 5 or 10 years. So not to confuse everyone, which I appreciate, I probably have already started or I'm already at the end of, it really is, the insurers really sort of have to be math whizzes to figure out how they're going to develop the program.
I think the biggest, eye-opening experience I have when I talk with entrepreneurs who are starting in the staffing spaces, they were very successful account managers, recruiters, and branch managers. Yep. And they really know their stuff when it comes to the front office, but there was always a corporate headquarters that ran payroll, did collections, did all the claims. And so, to the credit of the larger staffing firms, they really kept the house, recipe a secret for all of those branch partners, in terms of breaking the confidence or confidentiality between them. But not that they were like held, keeping them to like something that's critical to their own business. It was just that they were never taught it. They were just told as a branch manager, go out and sell. This is your cost of payroll. This is your gross profit. And then nothing else underneath.
And that system obviously works. I mean, all these mega billion staffing companies, they're extremely successful, and their business model is, the people in the field to have certain responsibilities, and the people in corporate have certain financial and accountability responsibilities, and it works for them. But as you know, when you're an entrepreneur, you've got to wear all different caps depending on what hour of the day or what time of the hour, part of the hour. And it's new. So I find when I work with newbies and even existing staffing companies that I'm able to take my experience of growing my staffing business and help them, hopefully, with what they're going through. And part of it is empathy. I think, you have to be, I think, to survive and enjoy staffing, you have to be an empathetic person, or try to, or want to be. I can't say I'm always as empathetic as I'd like to be, but I'd like to think I try to be. And, because it's a hard business. I don't have to, Matt, you're the last person I have to tell, because you know what it is to be successful in staffing. But you've got the temps and the employees, and they have a lot of needs. You have the clients, and they have a lot of needs, or prospects have a lot of needs. And then you're trying to put them together. And you're in the trench, and these folks are in the trenches. And if they're doing blue collar work, often it's a 24/7 or a 12/7 business. So when do they have any time off? Exactly. And even folks who are doing clerical, it's a high pressure business that they're in. And a lot of people, because just as you were saying, because they've had a corporate, a very responsible and well-oiled corporate to support them, they don't always appreciate how many things they have to put together to own and operate that staffing business.
Well, and I'll one of the things I try to teach and explain is that the businesses who are doing $6 billion a year in revenue are, the Robert Half's, the Manpower, the large Aerotechs, they're all most likely self-insured. So their costs of workers' comp is very or extreme, $1 million deductible. And so they're able to go after those at the branch manager level, but there's a zero cost of workers' comp truly to the, so their margins are acceptable in a large organization, but when they go out on their own, making 33 cents an hour might make sense, but oftentimes doesn't for somebody who has to pay their own bills, mortgage, and pay their, the rent. And so that's one of the big things, is really given, like, there's an unfair advantage when you grow up in the system, not needing to know workers' comp. But when you do break off, they feel oftentimes that they are going to be a big company. And I know a lot of them will grow eventually. But I try to talk about their payroll as a representative to the premium they would normally pay. And so what I explain it is, until you're really doing $50,000 in premium or more, you're going to have to factor in a lot of the workers' comp in order to get to $50 million in pay, or 50,000 in payroll. You need to be doing a couple million in payroll, depending on your workers' comp costs. And so do you have guidelines, like a small, medium, large type of guideline in terms of what you consider to be a startup versus a mid-sized staffing firm in your experience? Because a lot of people get 20 temps in the field and they think that they're a medium-sized staffing firm. And obviously at 20 people, they're still a startup phase.
Right. Well, the numbers that we generally use is, if they're a startup, then they really have two options. Let me try to answer your question this way. If they're a startup where they have no premium, they can either go into a state fund, or they can go and use an employer of record. Those are their two options. Because either option will take a staffing company with no history and no premium. If they want to get into a other alternative, at least with us, they need like a private carrier, and even a PEO, which will have lower rates usually. Then they'll need 3 years of work comp history, and usually $25,000 to $30,000 annual premium.
That makes sense.
We consider large premiums anything over $100,000.
Okay.
And how they generate that, usually is in blue collar type of codes.
Right.
Now, interestingly, we also have hybrid programs where we'll use perhaps a combination PEO and state fund, which is what I did. But what I was thinking of is I'm working with a construction company out of Tennessee, and construction, very high, relatively high risk codes. And they're going to be using a PEO, but some of their risks are so great because they're doing roofing, for instance, and they want to go well above 12 feet, which is the normal PEO limit. Right. And they also want to get into wind turbines. So they're going to have folks climbing up on windmill.
Green energy.
Exactly. So there's no PEO and there's no private care. And they've been in business 3 years, and they have relatively good loss history. And their premium is about $300,000 a year. And despite having a large premium and good loss history, a PEO still doesn't want to accept those high risks. No, exactly. So to try to get them the best rates possible, they'll probably be with a PEO for most of their codes, and then we'll set them up into a state fund into those windmill codes.
And that's really the benefit of working with you on that, is that you know the temperature, if you will, of all the PEOs, of all the people you're working with. And so you can kind of put together a plan if people are interested in really growing and scaling or not. Maybe it's just maintaining. You could help them kind of with a multiple option plan.
Right. And in fact, a lot of people don't know necessarily that there are over 700 PEOs in the country.
Wow, I didn't even know that.
Most crazy. People don't. But what most people also don't know is there's really only 10 that do a significant amount of staffing.
Yeah.
And my role is to make sure that one of the 10, if you qualify, meets the staffing company's needs. So they don't go through Google, search and start calling up, the 690 PEOs that do all 8810, do all clerical.
Yeah. Well, the sales rep on those guys will get you and tie you up for 2 weeks just to say, oh, you're a staffing company. Sorry, I don't do staffing companies.
Right.
I've heard those stories.
Right. So we try to be, part of our, I think our value is that we try to be time efficient with these folks.
Yeah.
Another sort of odd, speaking of hospitality, another interesting thing is most EORs or PEOs will really take a second or third look at hospitality because of so many W-2s. Yeah. Not so much because the risk is so great, but the W-2s and usually mean high turnover.
Yeah.
And with high turnover, it means more internal labor costs for the administrative function. So they often evaluate whether they can make money on that hospitality staffing company because they know there's going to be such high turnover.
Right.
But having said that, and since we're talking about figures, usually the administrative charge with a PEO or EOR is usually 2% of the payroll. So now you can opt for more services, and that number can go up. So, it's not one size fits all, but, for a very basic bare bones, if you will, it's about 2%.
Yep, sure. With the American Jobs Act, coming down its way, and like we touched on the green push for green energy and everything changing, not only in the government space, but eventually there's going to be money for infrastructure growth. How have you been kind of seeing the trends, or what are you predicting the job market is going to be like over the next couple of months and years as we transition?
Well, I think that the government right now is a purchaser of labor. And as a result, they've really, because of their subsidies, they've really skewed the market for good reason with the pandemic. They've skewed the market to have people they've paid people to stay out of the market.
Of course.
So now those subsidies are diminishing or being eliminated. And I think we'll see more and more people come into the job market. I think next week's labor number on Friday will be interesting. And And I'm not a betting man, but I do think it may be over 500 or 600,000. We'll see next Friday, so that'll be up quite a bit from the 200,000 we saw last month.
Yeah,
so I think we'll continue to see increases in that area, and I think I think on the volume side we'll see more people re-enter, but I also think what's interesting. I was reading this article in the Wall Street Journal recently, or just the other day, about how hospitality workers have had really the first time in some of their careers time off, where they've been paid to take time off. And sometimes things happen when you have idle minds, and they've reflected on their career, and they're not so energetic about going back kitchens and weird schedules and dealing with weird customers. And a lot of them, according to this Wall Street Journal article, are looking for new careers.
Yes.
And so I think we're going to see, they may be looking for careers in logistics, working in warehouses where they can get, like Amazon or FedEx, where they can get more standard schedules to work, and they may get better benefits than working in the hospitality industry. And I think we're going to see more training programs either come out of the government, or I think, the private sector is going to get more involved in training, because there's really a dearth of qualified employees out there.
Yeah, I have two predictions that I've been making. Okay. One is, I think that hospitality workers in the restaurants are going to transition to more of a salary role. I think with the everything that happened in 2020, I think as new people come into the restaurant industry as waiters and servers and in different roles, I think they're going to be transitioned to more of a regular paid hourly or a salary role like they do in Europe, where they're paid well and it's a career instead of a side hustle. And the second thing is, those people who left, who were really good in hospitality, the ones that were making good money, were still not satisfied with the benefits of unemployment. So they found a career already. They found, like you mentioned, went into logistics. Right. They started driving for Uber. They did something different.
Correct.
Or they went ahead and got a credentialing or certification in these things. I think what you were touching on is exactly right. The good people in hospitality have left, the hustlers who were happy with commission, with tips. They are left, I think, hospitality, and the new people coming into hospitality aren't those hardworking workers per se. I think what's going to happen is that they're going to say, I don't really want to work every Friday and Saturday night. Can I work and still make the same amount of money, but only work one of those nights? I think that's what we're going to see. I think we're going to see some changes.
I would agree, but I think because so many small restaurants have gone out of business, that the whole risk reward has really increased for small entrepreneurs who want to open up a restaurant, trying to get money from a bank or capital from lenders. Yeah. So I think we're going to see a consolidation of companies like Olive Garden, for instance. We're going to see many, many more Olive Gardens around, large food service companies, which is really what happened with the contract feeding business.
Yeah.
When we started with contract feeding in 1990, there were 15 to 20 relatively medium-sized or large contract feeders. And as the economics of the business changed, the smaller ones got out, and now it's dominated by 3 or 4.
Yeah.
I see that in a parallel happening in the restaurant business. It's just the cash flows are too, and for what you say, I agree that the workers are going to be asking and requiring steadier cash flows for their own lifestyles. Sure. And these small restaurants are not going to be able to supply it as easily. They don't have as deep pockets as the larger restaurant chains.
Well, I think there's enough money in the system. It's just that the hard workers would work Thursday, Friday, Saturday nights. They would stay extra. They'd pick up extra shifts, and they were good. I just don't think. I think that's going to be a change. I think people want to be in the hospitality industry. They just might not want to work every Thursday night, Friday night, Saturday night, and 8 days a week, if you will. But
right.
I also see some consolidation in the staffing and recruiting industries as well. The businesses who weren't managing their cash flow well, or were really taking large hits in terms of low margins in 2020, if you weren't managing your cash flow well, you couldn't survive in 2020. So I did see a lot of these medium-sized staffing firms really struggle. The large ones will be fine. And I think that the startups have an advantage in the fact that they can provide that high level customer service while at the same time, working with the customers on a one-by-one basis. So I think there's been some shifts to less so more going to the big firms, but more so that medium-sized staffing firm, if they weren't managing their cash flow well, I think they're going to continue to struggle throughout this year, but we'll see.
I agree. And while, you can't pay bills with pure passion, I do think that small staffing companies really will work, as you said, 8 days a week to please a client. Yeah. And I think the clients appreciate that. And I think that's why you have, the majority, I don't know about the majority, but you have, tens of thousands of staffing companies doing a significant part of the industry's business.
Yeah.
And even though you're right that the work comp costs may be higher, and maybe other costs may be higher, certainly their internal costs may be a little bit higher, but the clients are willing to pay that cost to get that type of that TLC from that smaller staffing firm.
From a workers' comp cost standpoint, do you predict any changes in terms of the cost of it? Is it going to go up or down, sideways in terms of expenses related to workers' comp? Any projections or predictions there?
Well, do you know how? I'll answer it this way. Do you know how old the workers' comp system is in the United States?
100 years? I don't know.
No, I'm glad I didn't make the bet. It's about. I think it started in the 19-teens.
Yeah, so it's First World War, I think.
Yeah, so it's a good 100 years. And interestingly, it really hasn't changed. It's changed and it hasn't changed. I mean, it's still there to cover employees, and benefits have increased in some states and then decreased in the same states and then increased. And it's really governed, as I said at the outset, by state laws and the legislatures that are in politically who are governing that state at that particular time. So, for instance, New York and California, maybe California comes up as number one, has the most generous benefits. Yeah. Why? Yeah. Well, they have a certain legislature. It's not that there's so many more accidents or that they're so more injurious, what happens to the employees. It's that they have a very liberal, frankly, generous, I won't use the word liberal, I'll get in trouble, but I'll just say generous legislature when it comes to giving out benefits. New York, similar, also has a administration that's bureaucratic, that's quite extensive, that adds to that. And then there are other states like Texas that are the same code, the same comp code, same job description can be 100% less than California.
It's amazing. You're absolutely right.
You go figure. And then Florida, for a while had, and again, I guess because I've been in this so long, for so many years had really high rates. There was, the legislature had really high rates. Then the business community lobbied them really hard and said, you're hurting our profits. So the legislature, and it was a big thing in Florida a few years ago, turned around and decided, well, we're not going to pay people as much when they get workers' comp. So all of a sudden you see the work comp rates come down in that state.
Yeah.
So, there's almost a story. There is a story behind comp in each state. There's a history and there's a story. One state that's very good is Ohio. Now, Ohio is what they call a monopolistic state, and their comp bureau is called BWC, Bureau of Work Comp. And they manage their claims so carefully that they actually give a dividend to, they send money back to their policyholders. And by being a monopolistic state, it means you can only buy comp for the 99% of the time. You can only buy comp from the state fund, and each state has its own state fund. So some state funds are run more efficiently. Texas, I would say, being one, and some are run less efficiently. California being one, and there are about 6 or 7, I believe, monopolistic states in the country.
Yep.
So, the answer to your question, unfortunately, is not just, I can't give you a one line. It's how are rates going? There are 50 different answers, and you have to really look at where each state's legislature is going with their comp management.
It's funny, things like OSHA is a federal type of monitor for injuries.
Right.
But it seems like workers' comp got grouped into that state-based classification associated with health insurance, with malpractice insurance, and not grouped on a federal level. Do you have any thoughts in terms of if that's ever going to change? Because really, so many businesses like Amazon are multi-state facilities, the same job in all the states. It makes sense to have a federalized workers' comp policy versus a state by state. Any thoughts on that?
Well, unfortunately, Amazon's not our client.
That's true.
So if Amazon's listening, we're available to be. We're open. Jeff Bezos.
Hey, Jeff, give my buddy a call here.
Jeff, even though I hear you're getting out of the business, we'll miss you. But in all seriousness, those really large accounts, they probably have so much pull with the legislatures in those states, and they really are maybe self-insured, that they really call their own shots. So it's really hard to talk about.
I'm sure they're self-insured. I guess my so many of our customers that we've seen have multiple locations in 2 or 3 different states, but the customer wants to sign one contract for the same rate for all 3 states, even though the workers' comp varies. And so we have to explain to the customer that, hey, it's different costs, and so it's always challenging that way.
Yeah. What we more often see, that's true. I've run up in those particular cases. Well, we've more often seen in a state like California where the codes may vary by, they're all light industrial codes, but they may vary, the rates may vary by 2 or 3 or 4%. In order to get the account, an employer of record, which does a lot of business in California, will bulk rate them.
Yeah.
So they'll give them one rate for all their light industrial codes. Right. And sometimes they try to offset it by hiking up the 8810 or white collar code a few points.
Right.
So, but that's really where I've seen comp rates merge, if you will. I think that can work with certain PEOs and EORs, but then you'll get to California or New York. So they'll say, here's your rate for 45 states, but you go into California and we'll have to have a separate conversation.
Yeah. I've seen that.
I mean, just because, as I mentioned, Texas rates are almost 100, maybe 80% less in California.
Right.
It's not even like 10 or 20%. It's so much different.
It's funny because they have kind of less regulations when it comes to some of the risks like home building and construction. There's like nobody watching what's going on. And so I don't know how they get away with it, but somehow they do. So I guess what happens in Texas stays in Texas. That's all I can think of.
Well, Pennsylvania is another state where they actually have their own work comp classifications.
I know.
As you may know. So, and their rates are certainly not as horrific as California's, but they tend to be higher than other states.
Yeah.
So I also think, the U.S., obviously is geared towards a federalist system of government. And I wasn't around back 100 years ago, even though maybe I look it, certainly some days. But I think federalism probably had something to do with the fact that each state controls their work comp situation. Now, interestingly, Canada does have a federal system for work comp. I don't know if we had spoken about that before, but when you sign up for Canada work comp, you can go all over Canada, and it's all government managed. And I don't know what they do in Mexico. I don't even want to.
Apparently, Mexico's going to be a big booming country soon, but we'll see.
Yeah.
So, great conversation, David. I'm really enjoying this. I'd love to talk a little bit about your business. You wrote a white paper. I'm just going to share our screen here. You wrote a white paper a little bit ago. So your website, staffingcompsolutions.com, is where people can get a hold of you. And under the resources tab, you wrote a paper about rural versus urban work comp rates. And I thought this topic was fascinating. I wanted to kind of go on to talk a little bit about this. And so can you explain, I know you want people to download it. So here's the link for everybody who, did I click on it right? Let's see there. The link is here, but can you just touch base on the basis of the difference?
Well, we've been reading articles, and there was a recent, very good article in the New York Times about how Amazon and FedEx have been setting up mega warehouses in farmland and agricultural land that's clearly near the interstates, so they can merge the transportation logistics aspects with the storage facilities of warehouses. And of course, the question is, at least in our world, is where are they going to get the labor?
Right.
And the labor is often going to come from nearby either current agricultural communities or former agricultural communities. And also most of these are near small towns. And these small towns have been the locations of manufacturing facilities that are unfortunately largely going out of business or have gone out of business. So these areas are on one hand welcoming this new business, this new logistics business, but on the other hand, the labor that's coming from these communities is really not prepared to do this logistics work. So it turns out, and we investigated, we researched that the muscles that one uses for manufacturing and certainly for agricultural work is very different than logistics in the Amazon warehouse, where you're running around lifting 50-pound boxes, for 8-hour shifts, versus in manufacturing, you're usually standing on a line where the product or widget is coming down the line, and you're doing something to the product or widget, and it keeps on going. So you're not so much lifting, you're standing, which may not be very pleasant, but you're not using those muscles. So Amazon, and there's been a number of, and I'm not trying to pick on Amazon because again, I'd like to.
You're not your customer, so you could.
I'd like to service their account. So this could happen to any mega company, but specifically, Amazon was incurring a lot of injuries, in part because it was hypothesized because the labor that they were securing was just not used to doing this type of physicality in their positions. So they've actually, to their credit, they've come up with a lot of different exercises, on-the-job exercises, to try to minimize those injuries, like any good company should.
Yeah, but so many businesses, I think, just group manufacturing and logistics and like everything kind of into one category, but it's very clearly not the case.
No, not at all. And what's interesting is, I know Amazon, I guess at some point started out with one warehouse, and now I don't know what the number is. Maybe they have 100 warehouses,
more, but probably.
Yeah, but they're going to, and they're employing hundreds of thousands of people at these warehouses. So this whole labor force that they've developed and they're developing will really incur or really test the local healthcare clinics, because they're the ones usually who get the work comp cases come to them. So they're getting sort of going up their own learning curve, trying to figure out how best to minimize these types of injuries.
Right.
So, they were programmed into, or they were modeled into working with agricultural workers or small manufacturing. Right. And all of a sudden they have, these tens of thousands or hundreds of thousands of workers coming to these clinics who just are not used to seeing these types of injuries. So it's, it's a very different labor environment.
Very good. Well, on your website, anything else you want to point out, or what's the best way that people can get in contact with you if they would like to talk to you further?
Well, my email is right there, David@StaffingCompSolutions, and my phone number is there.
Good.
And I wanted to point out that there's a nice drop down that says work comp options, which explores, and we have little videos for most of these options, which explores or details the different options that staffing companies should consider. Because it's certainly, and one reason I love doing what I'm doing, besides trying to help as many people as I can each day, is that it tests my creativity to figure out the best work comp option for the staffing companies that become our clients, and best meaning the lowest cost and most effective for them. Yeah. So please, at everyone's convenience, take a look at the work comp options, and feel free to give us a call. And even if it's just a chat, even if it's just to say hello, I'm here. And
well, you're practically famous because you're my reference, you're my workers' comp guru. So everybody else should be calling you just to get some knowledge from you, if nothing else.
Well, nothing else. Maybe I don't know what else is there, but no. But please just call to say hi, and even if they don't want to talk about work comp, which a lot of people don't, it's not always the funnest subject, but just to share with me about what's going on with their staffing company, I'd love to hear it, and I love to talk about sales, and I love to talk about personnel and different models, and that's the other fun thing about staffing we didn't touch on today. But almost each staffing company has a slightly different model to pursue their marketing. So anyway, I want to thank you, Matt, for your time and your invite, and maybe we'll be able to do this again soon.
It was a pleasure having you, David, and I really appreciate all the knowledge you shared with us. And thank you for everything, and I look forward to continuing our conversations. And please, I encourage everybody who's listening to make sure you connect with David one way or another just to learn. He's got some great videos on his website. And it's staffingcompsolutions.com for his website. So thanks, David. I appreciate it.
Okay. Thank you, Matt. Have a great weekend. Enjoy the holiday weekend.
Perfect. Thank you. Well, that wraps up episode 26 of Staffing Industry Discussion. And we had a great time talking with David today. And, his experience in workers' comp started in the 90s, and he's seen so many changes in the trends, more options, less options. But overall, his understanding of the workers' comp industry is really unparalleled, given his extensive knowledge and experience. And so I appreciate David for having him on the show today. And if you do have any questions, I'm always happy to refer any questions to David as well. But feel free to reach out to him directly. This has been another episode of Staffing Industry Discussion. Thank you for joining. Have a great day.